Alright, so now we are saying that the bookkeeper now is responsible for storing all these transactions in accounting books. Now, what are these accounting books? So, these accounting books, they are also known as journals. They are also known as books of original entry or books of prime entry. So, we just want to look at the example. It says, now it is the duty of the bookkeeper to record all the transactions in the books of original entry. Now, these are the primary books of accounts where transactions are first recorded. So to define a journal, we can say these are books where transactions are first recorded before being transferred to their separate accounts. So yes, by the name, books of original entry. So this is where transactions are first recorded before being transferred to their separate accounts. So there are 7 main books of original entry that a bookkeeper records transactions from. So all books of prime entry, they are recorded in chronological order. So say they are sorted by the date. So for example, today, let's say 2nd November. So the transactions happen, maybe you're buying something paid by cash. It's supposed to be recorded in a separate book of original entry. So books of original entry, they have separate duties whereby all books, they record transactions related to that book. For example, if you are purchasing something, maybe paid by cash, where are we supposed to record it? So there's a separate book that records all purchases made on cash. If you are paying for something, let's say we purchased some equipment on credit. Now, where are we supposed to record all the things that are purchased on credit? So there's a separate book that records all the things that are bought on credit. So all the books of prime entry, they have separate purposes that we are going to discuss as we follow. Now these books include, the first one is the cash book. So a cash book, this one records all transactions relating to cash. Okay, so all transactions related to cash are recorded in the cash book. Okay, so in this case, if the business is making transactions where cash is being paid immediately, those transactions are recorded first in a separate journal known as a cash book. A cash book is a book of prime entry and is also an account. We are going to discuss further as we move forward. But for now, you just have to know that a cash book is a book of prime entry that records all transactions related to cash. So it records all cash payments and receipts. So all payments that are being made, that means cash outflow, and all receipts, cash received, cash inflow, all revenues and expenditures are recorded in a cash book. Okay? So as we know, cash can be divided into two. Can be cash in hand, that the current cash that we have, and also can be cash in the bank. So all transactions that are made on cash between these two accounts, they are recorded first in a book of prime entry known as the cash book, whereby we just record all payments and all receipts, all revenues and all expenditures, all cash income and cash outflow. So it's either cash outflow in hand or cash outflow at the bank. So these transactions that are paid by check immediately, they are recorded in a separate column of the cash book called bank. So we record the date, the detail, and the amount that we spend. Okay? So the detail actually is what we are paying for. The date is when the transaction happened. The amount, how much have we paid or how much have we received? That's cash book. So all transactions related to cash, they are first recorded in a cash book. Now we have a sales journal. So a sales journal, so we are saying that all cash transactions are recorded here. Now you can think of other transactions. How about transactions related to payments to be made later? In this case, we have sold goods to customers, but payments are going to be made later. Where do we record those transactions? So those transactions are recorded in sales journal. Sales journal record all sales on credit. So sales on credit means customers, they have bought the goods, but they're going to pay later. Okay? So the terms in this case is like, we are borrowing customers' goods and they're going to pay later. So all those sales, names of those customers who have bought goods to pay later, they are recorded in a sales journal. So a sales journal takes all trade receivables. So all the names of our customers, in this case, they are called our debtors, also known as our trade receivables. They appear in a sales journal. So list all the days, like the dates, in chronological order from the list, from the beginning of the year to the end of the year, and then all the names of those customers, both goods and credits, they are listed in sales journal. So in a sales journal, it's also a trade receivables journal whereby all the trade receivables are found. And then we have the purchase journal. So a purchase journal, since this is sales, whereby the business, we are doing business, so business is selling. So in this case, to all customers that are buying goods on credit are on the sales journal. Now in this case, if we are purchasing goods from the supplier, but we are buying on credit, okay, to be paid later, and then we are recording those transactions in a purchase journal. So all purchases that are made on credit, they appear in a purchases journal. Only those that are on credit, because all cash transactions are being recorded in a cash book. But in this case, all these ones that are on credit, in this case to customers, in this case to suppliers, purchase journal. So in this case, it's called. So if you are recording all trade receivables, they are going to be transferred to a purchase ledger, but we are going to take them from the purchase journal. Okay. If we are going to transfer this to a separate account, which will be called a purchase ledger, now we are going to find all those trade payables, and then we are going to transfer them to their separate accounts from the purchase journal. But if we want to find all the credit suppliers, where are we finding them? In the purchase journal. Then we have a petty cash book. A petty cash book, actually this petty cash book records all small cash payments. Okay. Since we have this, a cash book, this is the main cash book. It records large amount of transactions that are payments and receipts. But if a business, they have a budget of small units of goods to be paid or to be purchased, to be bought, such as stationery, usually stationery, some bills. So they record them in a petty cash book, where small unit transactions paid on cash are recorded. So usually, small unit can differ from business to business. Business can decide to say, all payments that are below $50, they are going to be paid using the petty cash book. So they are going to be recorded in a petty cash book. They can set a limit to say below $50, all those payments will be paid in a petty cash book. To avoid congestion from the main cash book, so they just open a separate cash book for all the small unit transactions that are paid on cash. So another journal is sales return. So sales return journal. Sales return. So if the business, they are selling goods, okay, so they have goods that are selling, they are selling to customers in this case. So all the goods that were sold to customers, at some point, due to other reasons, whether the goods have been damaged, the goods have been expired, they made wrong orders, so the customers can decide to return the goods back to the business. So all the goods that have been returned from the customers back to the business that were once sold, they are recorded in a sales return journal. In a sales return journal is where all sales retained, they are recorded. It's also known as return inwards journal. Return inwards, they are coming from customers back to the business, recorded in a sales return journal. And then we have purchases return journal. So purchases return journal is just the opposite of sales. In this case, remember we had a purchase journal whereby we have recorded all credit suppliers, all the goods that are recorded bought on credit here. Now, if we have decided to return goods also to the supplier that were once bought due to other reasons, same as here, whether they are damaged, they are wrong orders, wrong size, they have delivered later, they have been delivered later. So all those goods that have been returned supposed to be recorded in a purchase journal. In this case, we are returning to the supplier. So all the goods that are returned out to the supplier, they are recorded in a purchase return journal. So a purchase return journal is also known as a return outwards journal. Now we have the general journal. So general journal. So a general journal, just like the word says, general journal. So this is a book of original entry that records all transactions that are not related to these journals. Okay. So all transactions not related to these journals are recorded in a general journal. So these transactions may include doubtful debts, recoverable debts, correction of account errors. So all those transactions that are not related to these are recorded in a general journal. So yeah, those are books of original entry. So these are books where transactions are first recorded. So these books is recorded by the bookkeeper. So it is the duty of the bookkeeper to record these transactions each and every day as they are happening before being transferred to their separate accounts. The reason why we have books of original entry, it is easy to track errors before they have been transferred to their real accounts. Okay? So to avoid mistakes, so mistakes can be eliminated earlier before we try to balance the accounts into their separate accounts. Another reason why we have the journals is that so it becomes easier to transfer accounts because the transactions have been sorted already. Okay, so it is easy to transfer them from the journals now to their separate accounts, to their separate personal accounts, where they can be summarized, where they can be balanced, and can be transferred for preparation of income statements. Okay. So it's the duty of the bookkeeper to record all transactions in a cash book if they are related to cash and bank payments and receipts. Okay. Sales journal if all the sales were made on credit. Purchase journal if all the goods bought from the supplier were bought on credit. Petty cash book if they have small units of cash to be paid for goods and services. Sales return if the customers have decided to return goods to the business if they were damaged, for example. Purchase return journal. Now in this case now we are returning goods to the supplier if the goods have been damaged. And the general journal. So general journal is a general book of original entry, records transactions that are not related to these books of original entry. So that's all about books of original entry. Next, we are going to discuss what is the double entry system. See you in the next video.